One dividend ETF that might pay you $1,500 more per year on a $50,000 investment. The other just delivered 47% higher total returns over 5 years. Most investors don't realize these two strategies are playing completely different games. If you pick the wrong one for your timeline, you're either leaving growth on the table or risking income you can't replace. I'm breaking down DGRO versus FDVV, the dividend growth champion, versus the high-yield beast, so you know exactly which fits your retirement savings plan. These aren't just different ETFs. They're fundamentally different philosophies about how to build wealth through dividends. Quick note before we dive in. I'm not a financial advisor, and this isn't personalized advice. This is education on two investment strategies. Always do your own research or consult a professional about your specific financial planning needs. We're looking at the yields, the total returns, what's actually inside each fund, and the one thing almost nobody talks about, dividend growth consistency. By the end, you'll know which one makes sense for your investment portfolio timeline. You'll understand why one fund bet big on tech, while the other spread across 405 holdings. Harry started building his investment portfolio 3 years ago. He wanted passive income streams for retirement, so he Googled best dividend ETFs and picked DGRO because everyone said dividend growth matters. Meanwhile, his buddy went with FDVV for the higher yield. Today, Harry's wondering if he made a mistake. Let me show you why this choice matters more than most investors realize. DGRO yields 2.04% right now. FDVV yields 3.10%. On a $50,000 position, that's $1,020 per year from DGRO versus $1,550 from FDVV. That's an extra $530 annually just for picking the higher yielder. For someone focused on wealth building through income, that gap seems impossible to ignore. Harry saw that difference and immediately started questioning his choice. His buddy was collecting more cash every quarter, and Harry felt like he was leaving money on the table. But here's where it gets interesting. FDVV hasn't just been paying more, it's been growing more. Over the last 5 years, FDVV returned 138.78% total. DGRO? 94.37%. That's a 44-point gap in wealth creation. On that same $50,000 investment, FDVV would have grown to roughly $119,390. DGRO would have grown to about $97,185. That's over $22,000 more in your account with FDVV. Wait, so FDVV pays more income and delivered better growth? Why would anyone pick DGRO? That's the question Harry asked me over coffee. And the answer is hiding in what happens quarter after quarter, not just year after year. The truth about asset allocation strategies is that short-term performance doesn't tell the whole story. You need to look at what's driving those returns. Because when Harry dug deeper, he realized his buddy's outperformance came with a price tag he hadn't considered. Let's talk about what you're actually buying when you choose these funds. DGRO holds 405 different stocks. FDVV holds 120. That concentration difference matters massively for money management and risk. FDVV's top holding is NVIDIA at 6.36% of the fund. DGRO's top holding is JP Morgan Chase at 3.12%. FDVV is making bigger bets, and that amplifies both gains and losses. And those bets are tech-heavy. FDVV has 26.07% in technology stocks. DGRO? Only 18.99%. FDVV also loads up on financials at 19.68%, while DGRO spreads more evenly across sectors. DGRO has 20.36% in financials, 16.90% in healthcare, and 11.43% in consumer defensive. DGRO even holds 6.97% in utilities. The boring, steady dividend payers that won't double overnight but won't crash either. FDVV is running a more aggressive play. Higher growth potential, but also higher volatility when tech stumbles. When NVIDIA dropped 15% in a bad quarter, FDVV holders felt it. DGRO holders barely noticed because NVIDIA isn't even in their top 10. This is where Harry started to understand the trade-off. He wasn't just choosing yield versus growth. He was choosing stability versus upside in his retirement savings approach. Here's the data point almost nobody looks at when comparing dividend ETFs. DGRO has grown its dividend for 10 consecutive years. That's a decade of reliable increases through multiple market cycles. The 2018 sell-off, the 2020 crash, the 2022 bear market. Every single year since 2014, DGRO investors got a raise. FDVV, 0 years of consecutive growth streaks. Let me explain what that actually means for your financial independence plan. DGRO's dividend has increased every single year since inception. The 10-year dividend growth rate sits at 8.91% annually. That's nearly 9% more income every year, compounding on itself. FDVV's dividend growth rate last year was 22.04%. Explosive. But there's no established pattern of consistent raises. FDVV's 5-year dividend growth rate is 10.42%, which is strong on average. But when you're planning financial independence, consistency matters more than occasional explosions. 1 year, FDVV might raise dividends by 22%. The next year could be flat, could even cut. For Harry, who's 15 years from retirement, this is the fork in the road. Does he want the fund that's proven it can raise income every single year no matter what the market does? Or does he want the fund that's delivered bigger total returns but hasn't established that reliability pattern yet? This is the tension at the heart of building passive income streams for retirement. The twist is that both strategies can win. They're just built for different phases of wealth building. If Harry's timeline is 20+ years and he can reinvest dividends, FDVV's higher total return might compound into more wealth. The compound interest effect over 2 decades heavily favors higher growth rates. That 138.78% 5-year return, if it continues, could turn Harry's $50,000 into serious money. But if he's closer to needing that income, DGRO's consistency and lower volatility become more valuable. Let me show you how the fees factor into this equation. DGRO charges 0.08% per year. FDVV charges 0.16%. On a $100,000 position, that's $80 versus $160 annually. Not massive, but over 20 years with compounding, DGRO's lower expense ratio adds up. That $80 difference annually, compounded at 7% returns over 20 years, costs you roughly $3,280 in lost growth. For serious money management, that matters. DGRO also scores an A+ on expense grade compared to all other ETFs. FDVV scores an A-. Both are cheap, but DGRO is literally half the cost. Here's another angle most investors miss when building their investment portfolio. DGRO's 1-year total return was 11.25%. FDVV's was 15.20%. So FDVV is outperforming even in the recent window, delivering nearly 4 percentage points more. But look at the momentum grades from a risk perspective. DGRO scores B overall for momentum. FDVV also scores B-. They're neck and neck on momentum, which tells you the market isn't clearly favoring one strategy over the other right now. The difference is in how they're getting there. So here's what Harry realized after running all these numbers. If he had picked FDVV 3 years ago, he'd have more wealth today. That 138.78% total return versus DGRO's 94.37% over 5 years is hard to ignore. His buddy was right to brag about the performance, but DGRO gave him something FDVV couldn't guarantee: predictable dividend growth every quarter, every year, for a full decade. That mattered more to his financial independence timeline because Harry's plan wasn't just about growing wealth. It was about creating reliable income he could count on. Let's look at the holdings one more time because this tells the real story. DGRO's top 5 holdings: JP Morgan Chase, 3.12%, Apple, 3.09%, ExxonMobil, 3.04%, Microsoft, 3.02%. Johnson & Johnson, 2.88%. These are diversified, stable, blue-chip dividend growers. Companies that have been paying and raising dividends for decades. FDVV's top 5. NVIDIA, 6.36%. Microsoft, 5.56%. Apple, 5.19%. Broadcom, 3.19%, 0.04%. JP Morgan Chase, 2.81%. These are growth-focused tech giants mixed with financials. Both hold Apple and Microsoft, but FDVV concentrates more heavily in each position. FDVV is betting bigger that tech will continue dominating. DGRO is spreading risk across energy, healthcare, and consumer staples. For Harry's investment portfolio, the question became, do I want steady compounding with lower risk, or do I want to swing for higher returns with more volatility? The answer depended entirely on his timeline and sleep at night factor. The choice between DGRO and FDVV isn't about which is objectively better. It's about which fits your phase of retirement savings and risk tolerance. If you're accumulating wealth and have 15+ years to let growth compound, FDVV's performance and higher 3.10% yield give you more fuel. The 138.78% 5-year return speaks for itself. You're getting paid more now, and you're growing faster. If you're transitioning toward income dependence and want proven consistency, DGRO's 10-year dividend growth streak and lower volatility are worth the trade-off. You're sacrificing some upside for peace of mind. Harry kept DGRO. Not because it was the highest performer on paper, but because it matched his actual timeline and goals. 3 years into his retirement savings plan, he wanted reliability more than upside. He wanted to know that in 2035, when he retires, his dividend income will be higher than it is today, guaranteed. FDVV couldn't promise him that. The lesson Harry learned applies to every investor building passive income streams. Know what game you're playing before you pick your fund. Don't just chase yield or total return. Match your investment strategy to your actual goals and timeline. If you want to build a diversified investment portfolio that combines growth and income strategies, understanding these differences is how you start. DGRO is the tortoise in this race. Steady, consistent, built for the long haul with proven dividend growth that never stops. FDVV is the hare. Faster out of the gate, higher income today, explosive growth potential, but less predictability in how that income grows year over year. Both can get you to financial independence. The question is, which path fits your timeline, your risk tolerance, and what you need your money to do? For Harry, slow and steady won his personal race because he valued certainty over potential. For you, the answer might be different. That's why understanding the strategy behind the ticker matters more than just looking at the yield percentage. One fund pays you more today. The other has proven it will pay you more tomorrow, and the day after that for years to come. Choose based on what you actually need, not just what looks better on a performance chart.